Welcome to BPM's IPO Readiness Roadmap, a series of conversations with our experts who have been there and done that when it comes to leading companies to go public or consider whether other options may be right for them. I'm John Weems, Head of Business Development with BPM, a top 50 accounting and advisory firm. And one of the reasons I'm excited to get up every morning is our work with founders and business leaders to become healthier, more efficient, more prosperous, and work with our teams to connect them with the resources to get there. Today, we are focused on the tax issues and opportunities associated with the factors in your decision on whether to go the IPO route, SPAC, or some of the other buzzwords that are flying around these days. Today, our expert is Julie West. She is the leader of BPM's corporate tax team. She also serves on our board of directors. And when she isn't working to raise her daughter, she's playing guitar, running marathons, doing all kinds of meaningful things in the world. So Julie, thank you for joining us today.
Thanks, John. Great to be here.
And Julie, I know you won't brag about yourself too much, but I do want to make sure our listeners know that you have worked with more than 40 IPO track companies and growing, that you worked with 4 who actually went public last year. So Julie has definitely seen some things out there. Fair to say?
Definitely.
Okay. So Julie, as you've worked with companies from the stealth angel stages to glorious IPOs or acquisitions to the tune of $2 billion, you've seen different factors. We've seen a flurry of activity and people trying to capitalize on current market opportunities. Based on your experience, will you walk us through a little bit around some of the factors that founders and their team should be considering with options, including IPO and SPAC?
Sure. John, right now investor appetite is hot for IPO and SPAC. And so there's a couple considerations as you're embarking down this journey to keep in mind. One is that these involve multi-year financial statements. So it's typically a big ramp up to get there. It could be 3, 4, 5 months. And I have some companies that want to do it quicker, and we'll try to do it quicker, but it's important to know whether or not you have the dedicated resources that can really focus on this, because there's a lot of intricate steps that need to happen. And some of the activities that will occur is we need due diligence calls, maybe with bankers or investors, and they really want to kick the tires and understand your accounting methods, your tax methods. So it's important to know kind of where your exposure lies on each of these items. And once you are a public company, you would have quarterly and annual filing requirements. So you typically need to staff up. And from an HR perspective, you need to think about kind of the human capital and the resources that you have, and whether you're going to use interim or somebody else to fortify your team, or whether you have those in place as well. Also, as a public company or approaching one, you're going to need an internal controls assessment. And so it's important as you start up that ramp up to get kind of a benchmark study and understand where you're at and where the potential pitfalls might lie. Lastly, I've seen several companies go through kind of the SPAC or IPO process, and this triggers a change in control for IRS purposes. And so there may be net operating losses or tax credits that we're banking on using that now have become limited by virtue of these types of exit strategies. So it's important to keep that in mind as well.
Okay. And for our listeners who are learning about SPAC, which was formerly kind of a 4-letter word people don't want to talk about, talk to us. You can Google it, learn a little bit more, but Special Purpose Acquisition Corporation. And you're happy to help you explore that as one of your options. Julie, we'll get back to the corporate side in just a minute, but want to talk a little bit to some of our founders and their C-level teams about stock comp. We know and trust that many of our executives are very altruistic, and that's all good, but we want to make sure that they're also factoring in tax implications on stock comp. Can you speak to that?
Yeah, equity is really, really important, especially if you're going through one of these processes. So having clean documentation of the issuance of founder shares, the exercise of those options, having 83B elections on file are really important for when that ultimate sale might occur, to make sure you understand what the treatment would be. I've seen a lot of founders who maybe were granted options by virtue of being a founder while they were an employee, and then they move into kind of a consulting role when a C-suite is brought into the company, and then they'll exercise their options. The IRS says if you earned those options when you're an employee, when you exercise them, they're compensation to you. So they have to be on a W-2, there has to be withholding, and so I see that get missed a lot. So that's important to think about kind of the classification of those equities. Also, if you're issuing incentive stock options or ISOs, there's a $100,000 per year exercisable a limit on those. And so a lot of people, if they let those build up for several years, might, by virtue of that limitation, have a portion of those no longer qualify as ISOs anymore. And so when they exercise, there will need to be withholding. So it's important to just stay abreast of those. Also, a company should get a 409A valuation at least on an annual basis, or whenever there's a big change in circumstances like signing a new customer contract or different situations. The IRS says that if your 409A is more than a year old, it is expired and invalid. So I get a lot of questions from companies like, how often do I have to do the 409A? When should I do it? And so also leading up to the IPO, it's really important to keep those types of things in mind. And lastly, when a person is selling their stock, there's a potential $10 million benefit called qualified small business stock. And this might be able to exclude $10 million on gain from sale of the stock. So it's important to think about that as well.
Good. And I know from talking to leaders of our private client services team, they always say the earlier the better. Even when you're thinking about founding your company, start talking to us about those options so you can prepare and take best advantage of those. Okay. So back to the corporate side, Julie, let's talk international. Many of our clients operate in multiple countries or are planning to. Talk to us a little bit about some of the implications and things to be aware of there.
Yeah, so the first thing is just the worldwide structure. Where do you have entities and where should you? Because if you don't have a legal entity set up in a foreign jurisdiction, it's possible that they could say you have permanent establishment and they could try to tax your US earnings in a foreign country. And once you do set up maybe a subsidiary in a foreign country or a brother-sister company, you need to make sure that you have the proper intercompany agreements in place saying, okay, who's going to provide what services and at what compensation. And there's an arm's length compensation between related parties. And so a lot of times you'll need to do a transfer pricing assessment to determine what that arm's length compensation would be. And if you don't have one of those in place, there could be implications for both a US and a foreign tax jurisdiction. And then thinking about where you want the IP to reside. It's common for companies either to register their IP in the US or try to transfer it to a low tax jurisdiction, or to get some IP that maybe is in Cayman Islands and want to repatriate it back to the US. So those laws have been changing a lot very recently. So it's important to think about worldwide really where you want that to be.
Okay. Julie, talk a little bit about some of the pitfalls of due diligence you've seen along the way when it comes to people on the IPO track.
Yeah, so I would say the non-income based taxes are the ones where I think we see the most surprises. So everybody's aware of non-income tax, of income taxes. If you are in income, you pay liability. But what about sales tax? What about VAT in the EU? What about the San Francisco business tax? So I had a company once that did software as a service, or SaaS, and they were located in California. And in California, SaaS subscriptions are not taxable for sales tax purposes, but in about half of the other states they are. So they found that they had about a $2 million exposure once they started looking and going back and figuring out where their sales had been. So I would say that making sure you notice the other types of taxes as well are very important, and that's where I see a lot of reserves or a lot of questions in the due diligence.
So Julie, as we come to close, let's talk a little bit about trends and other observations you have from the marketplace. Certainly, we've seen a lot of movement of remote workforces. People looking at other HQ locations. Speak to some of those factors.
Yeah, so we are seeing with COVID, we're seeing employees working from all different locations, and maybe they've kept the payroll in the state they used to be in. Maybe they have changed the payroll over. So we're having to ask companies more and more, do you have specific knowledge of where your employees are located? So you might have an employee who was previously located in California, and now they've been working from Lake Tahoe in Nevada, where there's no personal income tax. There could be implications to the company about where they need to start filing tax returns related to that. And each of the states has come out with their own guidance about temporary relief for COVID. And of course, there are 50 different determinations for 50 different states. And so it's important that companies are aware of that and they're changing footprint. And also, as you mentioned, companies have been moving headquarters. So Oracle has moved their headquarters from California to Texas, another state where there is no individual income tax. So this has important ramifications because Texas has a franchise tax, not an income tax. And so it's just important that companies that are moving globally and within the US are aware of where they're headquartered and where their employees are as well.
Well, Julie, thank you very much for your time. We appreciate it. Again, Julie leads our corporate tax team. The IPO readiness team spans multiple disciplines. We really strive to be a one-stop shop for you. We have alliances with law firms and banks and many others as well, if that's something that you need assistance with. Would encourage you to subscribe to our YouTube channel at BPM CPA. Follow us on LinkedIn. We'll be having future conversations that include some more specific matters around people, technology, and some efficiencies to help you evaluate whether IPO is the right way to go for you. Thank you for your time, and we'll see you in the next episode.